Yeah, can you able to see my screen, sir?
Yeah.
Okay, sir. And this is our financial statement analysis and introduction. Basically, we have a financial reporting and analysis we call FRA. This FRA is consisting of approximately 15 to 20% of weightage. So directly I am entering into the concepts in this financial statement analysis and introduction. Basically, sir, financial reporting, this financial reporting plays an important role in every accounting firm. So because every person who are going to invest in a company, he first need to understand what they reported in the financial statements. Okay, so that is the reason all these financial statements which are reported are in the same manner. So they are consistent, they are timely manner. Every financial statement must be reported a particular period of time, and it includes the entire company's performance. Okay, so that is the reason these financial statement providing information on performance through the income statement. So they are preparing the income statement and providing financial information performance through the financial position through the balance sheet. See, we have a income statement, we can able to identify not 100%, but we can able to identify the performance of the company or performance of any other firm. And to know the financial position of the company, there is a need to read the balance sheet. So reporting helps to the users. Users are nothing, users are simply we can say investors, creditors, who are going to make use these financial statements. So all these information, performance, position, everything will be revealed by the financial reporting by the firm. And when come to analyst, financial analyst, we are taking the financial statements and analyzing them, evaluating them, and we can able to evaluate the past performance, present performance, and future performance of the firm. Because the data, quantitative data, they presented in a perfect manner according to the standards. We will go to the standards again, but according to the prescribed framework, according to the prescribed conceptual framework is there, according to that report, according to that standard, they reported this financial statement. So we can able to identify the performance for the future. Also we can estimate the future performance of the company based on the past experiences, profitabilities, and the current and past cash flows in the business, and the liquidity position of the company and solvency of the company based on the provided financial reports. Whatever the reports available, based on those reports we can able to estimate the performance of the company. And because of that, we need to understand about income statement. So income statement reveal the financial performance of the company. As we know that income statement is consisting of just revenues less expenses of the company, and after that these revenues or expenses we will again read in detail, but just a overview of this financial statement I am giving you. This financial statement consisting of revenues, expenses of the firm, and tax income before taxes. Okay, and after payment of the tax, what is the net income available? This shows the value of the firm, means it shows the performance, not the value in numbers, the value in feeling. We can able to understand that the company is earning this much of income, so it may be earned in future also, like that we can estimate. But lot of things we need to understand about these things, then only we can come to a conclusion about the performance of the company. When come to the balance sheet of the company, balance sheet, balance sheet expresses the financial position of the company. Under balance sheet, you have to understand the simple concept here, equation here. All assets are equal to liabilities plus equity. Okay, this equities, what is equity, what is liability, what is asset, we can just go into in detail. And cash flow statement, whatever the company is doing, operations, investing, financing, these type of activities it is doing during the particular period of time. So what is the result, whether the company's performance is good or not, can be identified income statement, no doubt about it. And the financial position is explained here. But what is this cash flow statement? So cash inflows and cash outflows determines the basic liquidity ratios, solvency position, liquidity position, profitability, all will be understandable. Because income is higher, if you observe the income, you cannot say that the entire income is because of from operations. Maybe the income is higher because there is a profit and sale of the investment, profit and sale of the asset. So that included in this profit, you cannot estimate directly the performance of the company is good by checking the income statement. So you have to understand, you have to study, you have to analysis income statement, balance sheet, cash flow statement also. Then only you can able to say that the performance, position and everything would be good. And one more thing you have to understand in reporting, the company's management is also issuing a management discussion and analysis sheet. So this is a statement here. According to this statement, with the help of within these statements and after the financial statements also, the company is giving the footnotes. Based on the footnotes also, we can identify the what is the opinion of the management, why the management is treating these type of assets like this, and why the management is showing these incomes under the income statement. Okay, everything will be decided and identified. A qualitative information is also provided in this management discussion and analysis. So basically this management decision and analysis contains a overview of the company and important information about the business trends and what are the future capital needs available for the company, and how can they pay off their debts, and what is the liquidity position, and what are the important significant decisions they are going to take for the development of the business, and what are the main accounting standards they are applying. If the accounting standards would be changes, what is the impact on our accounting, how the management is going to be judge the taking the decisions based on the situations, like that entire overview of the company will be expressed in management discussion and analysis. And the management is also providing the internal control system. This internal control system is basically most important. So without the proper internal control system, the assets of the company will be used by some other else and they cannot able to produce a proper profits for us. So we have to put a constant control system. So for example, if you are not paying the salaries through the bank or check, automatically what will happen, the person who is paying the salaries will pay lesser amount or higher amount, and he can get some sort of commission from the employees, and he can prepare, for example, the salaries are prepared internally, the whatever the salary payments, salary sheets are prepared internally. There may be a choice of manipulation. That is the reason the firm need to put a lot of internal control systems or lot of internal control measures to protect all these type of frauds. Then only it is possible to submit or report a fair and true value of the financial statement. And it also explains, the management discussion analysis also explain the future outlook, and also assuring the real fair view value, future outlook, what they are going to take a future decisions. Based on that also, this is a lot of a qualitative information, not a quantitative information. Whatever the quantitative information is there, that will be provided in profit and loss account, or say income statement or balance sheet. Okay, I'm moving to the next slide. After that, in the reporting, in the financial reports also, it is also consisting of auditor reports. So whatever the management is decided, written and published, the financial statement is not up to the true or fair, we cannot able to identify, because it must be tested it must be tested by an independent authority. Then only we can able to identify, we can able to understand these are true and fair. Because to show the company's performance very higher, the company may include unnecessary profits also. Okay, and to increase the value of the balance sheet, value of the financial position, the company may include some other assets which are not related to the firm also. That is the reason all the reports whatever published will be tested, will be evaluated by the independent auditor. So then after verification by the independent auditor, and he can also submit a report called, that is, auditor's report. Basically the objectives of audits of financial statement is provide an opinion on the statements. Which type of opinion? Okay, these financial statements are true, fairness is there, and they are reliable. So you can able to invest, I mean not exactly that, you can take a decision, your financial decision based on these financial statements, because they are showing true and fairness, they are reliable. Okay, like that he will issue an opinion. So auditor opinion gives evidence of independent review of the financial statements. So whenever we have an auditor opinion given, he is not giving directly, he is checking all the evidences beyond the each and every transaction, then only he can come to give an opinion. And he verified the accounting principles, whether the company is prepared as per the accounting principles, accounting standards, or it is, whether it is in the framework, whether it is there in the framework or not, within the framework or not, he will be tested everything. And the auditor is also having the standard auditing procedures. Based on the procedures, he can check and he can assure the users of the financial statement there is no material error. So there is no material error means these are prepared within the framework. What are the compliances are there to follow, all those compliances are fulfilled, and it is true and fair view. All the assets published in the financial statements are true, available in the company. Whatever the revenues are generated by the company, also true, and fairness and reliability is there. Like that he can give you a opinion and says that there is no material errors. Okay, and he also need to review the internal control system, whether the internal control system is correct or not. If the internal control systems in the organization are not correct, then what will happen, then automatically there is a choice of frauds. So he can also view the internal control system, review the internal control system, and gives opinion on that the company's internal control system is perfect. So based on his checking and everything, auditor can issue 3 types of opinions. Basically, actually 3 types, but we can also classify one more type that I'll tell you. And one is unqualified, second one is a qualified opinion, and third one is adverse opinion. Fourth one is nothing, he is not saying anything, means disclaimer of opinion. He cannot able to give any sort of opinion on this. So these are the 4 types of opinions a auditor can issue. So an auditor can issue a qualified clean opinion. It is also called as a clean, means it is, there is no material errors are involved in the financial statements. It is prepared according to the standards, and you can rely on these financial statements. Like that he can issue. It is an unqualified opinion if the statements are free from material errors. So the financial statements are free from material errors and material omissions. So it is a perfect clean opinion. And second one, the auditor may issue a qualified opinion that denotes any exceptions to accounting principles. If the company, if the firm is not following, for example, US GAAP, so it can say that it is a qualified opinion, and I am expressing that these firms are not following accounting principles. So it is not following US GAAP, or it may be did something error to the. Hello.
Hello.
Yes sir.
Yes, sir.
What?
It's okay. Okay.
And the auditor can also issue adverse opinion if the statements are not presented fairly. So whatever mentioned in the statements are not fair means maybe not true, maybe some sort of frauds are involved. It is an adverse opinion. If the adverse opinion is issued, definitely the management need to change some sort of things, and it must be a clean opinion. Okay. And next one is disclaimer of opinion, means the auditor can issue this disclaimer of opinion, means he is not unable to express any sort of opinion because the data is not available, information is not available, the accounts are not understandable to him, then it will be a disclaimer of opinion. These are the 4 types of opinions will be given by the auditor. There may be a choice of getting one question from this.
Yeah, excuse me about this opinion. Where he will put it clearly, his opinion, qualified in the statement or in his report? It will be in the front page, you put qualified opinion, or it will be structure the report?
No, you are talking about the financial statements, or you are talking about the auditor report?
No, auditor report.
Okay. And here the most important thing we have to understand is a company's management is responsible for maintaining an effective internal control system to ensure the accuracy of the financial statements. You know, sir, financial statements are prepared by the accountants in the company, or maybe he may be a CPA or qualified, or maybe normal accountant, whatever it may be, and it is he is getting the data from different departments, purchase department, sales departments. If the purchase department internal control system is not properly established, you know, they can modify the data, right? And if the sales department or a marketing department, if any other department is not perfectly internal controlled by the company or management, there is no proper system in it, definitely there may be a choice of misstatement, or we can say the accuracy level would be reduces. That is the reason it is the duty of the management to maintain the proper effective internal control system within the organization. And also, most important thing, as a financial analyst, we have to remember that not only based on the financial statements annually issued by the company, we have to concentrate on quarterly statement and semi-annual reports and proxy statements, press releases, earning guidances, and corporate reports, and other industrial information, other information from industries or peer group. External sources also most important for analysis. For example, you know, this yearly statement shows a very good impact, but quarterly you can estimate, okay, what is happening in this quarter, it may be affect the company in remaining 3 quarters or 4 quarters, like that you can estimate. And semi-annual report is also most important, because our financial decision is if, for example, based on our financial decision, if someone invested, within one day only the stock price maybe increases or decreases a lot, so lot of losses would be there in investing based on this last 3 months 4 months back financial statement. If you take the values as a current values, is really a foolish thing, because the financial statement is expressed only at that particular date. Please understand, 31st December, that's it. On 31st January what will happen, we don't know, and 31st March what will happen, we don't know. So 3 months duration would be there. That is the reason, as an analyst, before going to invest in any company, or before taking any sort of decision based on the credibility or liquidity of that particular company, please check quarterly statements and semi-annual statements also. For example, proxy statement. These proxy statements are, for example, if any company or any firm want to take a decision regarding the promoter share, or issue of bonus shares, or buyback of shares, all these share need a shareholders permission or shareholders voting. How they are going to conduct the shareholders voting, and what are the things, and what are the decisions taken in the shareholders voting, all these will be explained in proxy statement, especially it is related to this relation in between the shareholders and the company. And press releases. So many things happen in business life. Someone is filing a insolvency petition about the on the company, so automatically it reflects the financial credibility of the company, on goodwill of the company. and it also we have to understand the earning guidance, how they are going to earn in coming future. Every report which related to the industry peer is also important. For example, I am doing my analysis in a particular Airtel Industries, so I need to understand what is happening in the Geo, because a decision taken by the GE is also affected the Airtel decision. So all the things we have to understand before giving a proper investment decision as a financial analyst. So statements are okay, qualitative information, quantitative information, but these are the qualitative information we have to study properly before coming to a correct decision. Okay, the framework for financial analysis has six steps. These are the financial analysis steps. A financial analyst first state the objective of analysis, why you are going for these financial statement analysis. For example, I am a PhD graduate, I am a research scholar, I am doing this research, so I'll go ahead and explain my objective. For example, I am going to take an investment decision, so then I'll explain there this is my investment objective, and gather the data which is related to that particular company, process it and analyze and interpret the data. In the process, what are the data you are required, you will take that particular data. In analysis, you will use so many analysis techniques, ratio analysis, comparative analysis, comparative balance sheet and percentage methods. So you can take any method for evaluation for your decision making, and report the conclusions and give your recommendations, and if there any changes are there, you update the analysis. This is the 6 steps basically we are considering for analysis of financial statements, but it is depends upon the situation to situation again in the real life. So now we are coming to the transactions are recorded in accounts that form the financial statements. So each and every transaction whatever involved with the company will become a transaction, each and event will become a transaction. All the transactions recorded in accounts, then only the form of all the accounts will come together, will become a financial statements at the end of the year. Transaction recorded in journal and it will be recorded in accounts. Accounts will be make the trial balance, and trial balance will be a financial statement. This is the oldest classical of flow of accounts, and we have to understand what is the account. Okay, then we come to accounts. What is the accounts? Accounts are firms' economic resources. The best examples are accounts are cash and cash equivalents, accounts receivables, inventory, financial assets, marketable securities, prepaid expenses, expenses which are paid in advance, means our money in the hands of the other person, so whenever we ask they will give back. So current assets means prepaid expenses, or we can also give property, plant, equipment. These are the non-current assets or depreciable assets. Investment in other companies. Okay, so many assets are there like this. So we will basically we have to remember these are the resources. Then I'll explain each and every account later. And what are the liabilities? These liabilities are duties, or we can say creditors' claims on company's resources. Whatever we have a resources, that is asset. If someone is claiming this, then it is the liability. Okay, so for example, you take a bank loan for purchase of this particular asset, so it is becoming a debt or liability, or say loan. This loan, he is having all the rights to acquire our assets if we not paid our dues. So it is basically it's a right for the others and duty for us. Okay, and second thing you have to understand is owner's equity. So owner's equity is, you know the equation here, assets is equal to liability plus equity. Okay, this equity is the owner's equity, who are the invested in the company. Basically in companies we can call it as a paid up capital, common stock or preferred stock. Whatever the returned earnings are there, which are, for example, in this business we earn, for example, 100 million, So in this 60 million paid to the shareholders as dividend, and remaining 40 millions are there in company as a retained earnings. So this is also given to the equity shareholders, but not now, we will keep in our business only. Okay, retained earnings. So owner's equity consisting of entire paid up capital of the common stock, preferred stock, retained earnings and other comprehensive incomes also. Okay, so this is because of entire thing is happening because of double entry bookkeeping system, double entry accounting system. In income statement you have to understand the revenues. Revenues are nothing but the sales and investment income. Whatever you invested in outside, you are getting some sort of income, that is maybe interest, dividend. Okay, this is also considered as a revenue. And the gains on sale of a properties, for example gains on sale of any other plant or equipment, this is also considering as a gain now. And expenses, when come to expenses, we are talking about the income statement, revenues are there, expenses, its expenses are nothing but the cost of goods sold. Expenses are selling and administrative expenses. And you are using a property equipment in your business and it will be depreciated over a period of time. The depreciation is also loss for you, that loss is also considered as expenses, because this is using for production of goods and services, and it is because of matching principle. Okay, and interest payable, you took a bank loan and whatever you are paying interest, taxes and loss on sale of assets, everything will be expenses. These two will be matched because matching principles, and everything finally you will get. If you are getting a positive value, it is a profit, and if you are getting a negative value, it is loss, and based on this the performance is identified by the analyst. And one thing you have to remember, for revenue recognition, each and every item what is coming into the business is not exactly a revenue. Okay, so that is the reason you have to identify the revenue properly. That concept is called as a revenue recognition. Okay, and we have an accrual concept for revenue recognition. Accrual concept insist, actually you have to follow this, insist the firm revenue, the firm recognize revenues only they are earned, means only earned. I will give you a classic example here. For example, I am teaching you per hour $20 example, and you already paid me $600. Okay, so this $600 is received, okay, but not earned. I am not yet earned this amount, because received. Whenever I give you a 1 hour service, then this will be earned. So today I earned only $20. Okay, and whatever I received is only a cash received. This we have to recognize the revenues only earned. So today my services are $20, so that is my revenue earned. Understand, sir? Revenue recognized only when they are earned, and expenses when they are incurred. When they are incurred, for example, you paid me 600 and entire amount is not your expenses. Today whatever you received services, that is only your expenses. For example, for insurance premium, you paid 1 year insurance or 3 years insurance, for example. So 1 year completed, so you paid 300, so only 100 is the expenses incurred during the year. So this is the accrual concept. Whatever exactly how much accrued will be considered. Okay, and here the timing of revenue or expenses do not match. So timing you paid for how many years? 3 years, but this timing is not considered. Only 1 year is completed, 1 year revenue will be 1 year expenses will be considered. Okay, do not match recognition of the financial statements. Payment is for 300 for 3 years, but this year I am preparing only one financial year. I am preparing first year. This year only 100 expenses. In second year again 100 expenses. And one more thing you have to understand here is, one more classic example I want to give you, please understand. And you purchased here 100 units, that is your cost of goods sold actually, but you are not selling this here in this particular year. So this is the first year you are not selling. What is your cost of goods sold? 0. Please understand, sir, because your cost of goods sold 0 and you are showing it as a current assets as inventory. inventory, and when you are selling here, sold here, and your cost of goods sold is COGS is again 100. So this is also matching principle. You purchased on the first year, but you are selling at the end of the second year, and you are recognizing the revenues here, and the same manner you are recognizing your expenses here. This is matching principle. Understand, sir? Okay, I am moving to the next topic. Financial reporting standards are designed to ensure that the different firms comparable to one another. So we have different sort of firms in the world, and different companies, different categories, they are doing business in different sectors, whatever it may be, but it is a financial company and it is doing business. So company A, company B, even they are working in different sector or the same sector, must be easily possible to comparison only if they are prepared within the framework of financial statements. That is the reason these standards, these financial reporting standards, designed to ensure that different firms comparable to one another. If they prepared within the framework only, then only it is possible to compare properly. Okay. For that, we have, for designing all these financial reporting standards, actually we have standard setting bodies. All these standard setting bodies are private sector organizations, or maybe academics, or maybe CPAs, or experts in accounting. They will work and they will prepare these financial reporting standards. All these people are working under as a group, that is okay, accounting, International Accounting Standard Board, IASB, International Accounting Standard Board, and FASB, Financial Accounting Services Board. Okay, these are there for us. Okay, and people are working under this academic, professional, accountants, auditors, they are working. And this is not final, please understand. Whatever they are setting the standards, they are not up to final, because it must be approved by regulate authorities. So because these regulate authorities are government agents that enforce these compliances, whatever prepared by the standard setting bodies will be enforced, okay, in the countries. So these agencies, that government agencies that enforce compliances with financial reporting standards, such as SEC, Securities Exchange Commission in USA, FSA, Financial Service Authority in UK. Okay, many other nations also having different authorities, but all are belongs to the International Organization of Securities Commission, IOSCO. And you know, all these are basically watching the capital markets. Okay, basically they are concentrating on capital markets and they are studying the capital markets. Okay, you know, Securities Exchange, FAS, everything is basically securities. So finally, you know, they are the ultimate decision makers, no, security holders. So they, for protection of them, they are issuing the different type of standards and different type of compliances. Basically, please understand, sir, here standard setting bodies and regulatory authorities both are different, and IASB, FASB are standard setting bodies, and Securities Exchange, FSA in UK is regulatory authorities. In India also we have ICAI, IA standards they will issue. Okay, different companies are, and the most important thing is different companies, regulatory authorities are having different opinions. Each country's political background, situations are different, and accounting standards are common, for example, but some of the differences also there. That is the reason we have international financial reporting standards. Okay, so if you want to list in your business in US, definitely you have to present your financial statement according to the US GAAP. Okay, if the US company is listing in any other country, for example, US company is listing their shares in any other company, they have to present their reporting standards for international financial reporting standards within the framework. So there are little gaps in between the IFRS and US GAAP, but before 2014 those are most of the differences are there, but now they are reduced and only few differences are there. We will learn each and every difference in detail when the time comes, when the item comes. Now we are going to the financial reporting standards conceptual framework. For the financial reporting, every firm, whatever they are reporting in their financial statement, they must follow a conceptual framework which is issued by IFRS. Different standards are there, those standards the firm must follow. Okay, and reporting is this is because enhancing the quantitative characteristics of financial statements. If you follow this, it will be definitely understandable to everybody, and it is comparable to every company. Okay, and this financial conceptual framework also establishes some reporting elements, notes, constraints, assumptions. All these things are followed while preparing the financial statement, then only it is possible for comparable and universally acceptable also if you follow all these things. And these financial characteristics of financial statements, the fundamental characteristics of financial statements are relevance and faithful representation. Okay, the enhancing these characteristics includes comparability, verifiability, timeliness and understandability. Okay, all these things characters will be there if you follow this framework. Cost versus benefit. Okay, and non quantifiable information in the financial statement, it is very difficult to capture. So all the numbers, okay, only quantitative information would be there. Okay, non quantifiable would not be there. The next important item you are going to understand is general features of financial statements. Okay, according to IAS number 1, every financial statement must be prepared based on these features. These are the general features must follow. Every financial statement must be fairly presented, and going concern concept is must follow. Going concern means you are doing the business now, your business is running infinite years, so unlimited years. Life of the business is not at finite. So like that you have to prepare your financial statements, then only you can divide assets and incomes. The comparison must be there. Okay, and accrual accounting, accrual accounting, this whenever you are earned will be recorded, not at whether you are received or not, you don't bother about it. Whether you paid or not, don't bother about. Whether you expensed or whether you consumed or you earned or not earned will be recorded according to the accrual accounting. And consistency, this consistency means every time you have to follow a basic method, same method. For example, for valuation of inventories you took method A, so method A is LIFO, for example, the last in first out method. I will explain you later. And if you are converting in this year, second year, in the second year you are changing FIFO, it is not correct. Actually consistency is missing. Okay, like that depreciation, in the first year you are using straight line method, in the second year you are coming to diminishing or declining balance method. So this is also not correct. You have to use every year. First you use the straight line method, you use straight line method only, not a problem. Or if you want to use declining method, from the beginning only you have to use that. 1 year this, 1 year this is not correct. It is not consistency. And materiality, so whatever you feel it is material to the business, all the material item will be recorded in the business. So
except back on the depreciation.
Okay, these are the basic features we have to follow. When come to materiality, if you feel whether it is not material, it is immaterial. For example, in small papers, for example, when you are evaluating your assets, this small paper pieces or small newspapers are available. These are immaterial. For example, pins, smaller pins, okay, you know, the staplers or small pins, those are not, those are paid for cash, those purchased for cash only, but immaterial to mention in your balance sheet. Only you can write a stationery, that's it. Okay, right, only material things will be recorded. Aggregation, okay, all aggregate figures you have to show. No offsetting. So for example, you are feeling that there is a loss in the last year. If I go back and take the losses here and I'll show these losses, there is no such type of offsetting is possible. And reporting frequency must be 1 year, and comparative information only be recorded. So there is no such information, it is not incomparable, it is not comparable with other company details, you cannot show that. For example, if you are showing that the closing stock is, or inventory is 100 units, but you are not mentioning a price here. Without a price, there is no value, there is no quantitative information, it is not possible for comparison. Okay, IASB and FASB frameworks are similar, but some remains some sort of differences. Those differences I mentioned here in short form. IASB lists income and expenses as performance elements. Okay, income and expenses as performance elements, while FASB lists revenues, expenses, gains, losses and comprehensive income. Okay, it is shows revenues, expenses, gains, losses and comprehensive incomes. You know, IASB lists only income and expenditure. Yeah, once again I am repeating, IASB lists income and expenditure as a performance elements in the balance sheet. Okay, this only sorry, in the income statement they lists only income and expenditures, while IASB lists revenues, expenses, gains, losses and comprehensive income. You know, it increases the steps. Revenues are incomes, no doubt about it, here revenues are incomes. When come to expenditure, expenses and gain is also revenue, and losses and comprehensive income, they given separate things. Okay, whatever the real income is there according to ISBS, it is a real income, but here gains are there, na, sale from loss on sale of gains, this is separated, it is not included in the income according to the FASB, it is separated. Got my point? And next is the FASB is really strict. Probable, when defining assets they will use word probable assets, not direct assets. Okay, and FASB does not allow the upward revaluation of the most assets. For example, if you want to revaluate the asset, the value, the book value of the asset may be higher in the market. For example, if you want to revaluate your asset, it is not possible according to the FASB. You depreciated something. So for example, you purchased the asset during 1960 for $100, then the value according to the book is 0, for example. But if you want to upward this, because it is having economic value, you are now using, if you want to give value to this asset, FASB does not allow upward revaluation. It is not possible for revaluation. Even though it is having economic life, it is not possible according to the FASB. Okay, firms which are listing their shares in United States need to reconcile their financial statement with US GAAP. I already told you, if the company is going to be list their shares in the United States, they must follow US GAAP or IFRS. If you are not going to list your shares, there is no need to. But if you want to list, because you are listing means you are becoming a multinational corporation, so definitely IFRS must be followed. I am giving you importance of the financial statement framework. A financial reporting framework must be provide transparency and comprehensiveness, consistency. These three are most important. Okay. Now, just now you asked, no, sir, about IFRS differences. That I am coming. Under IFRS and US GAAP, companies must disclose their accounting principles, estimates in the footnotes, and managing decision and analysis. 1. Public companies are required to disclose likely to impact recent issuing accounting standards on their financial reporting. So the public companies, basically they have to explain, they have to disclose in their management discussion or somewhere what is going to happen if the accounting standards are changes in my financial statements. So for example, the accounting standard of particular IFRS 10 or 5 is changing from 2019. So what will happen if that changes in my financial statement? That projection also given to the public. Okay, because public companies especially they are mentioning, because public companies are publicly held shares are there, public held shares in the company, that will be affected them. That is the reason a prerequisite pre-information should be given to the public. Analysts should be aware of evaluating financial reporting standards and new products and innovation that generate a new type of transaction. So the existing standards are there, but we are doing a different business, a new business. My business and my product is not coming in that particular sort. What I'll do? So then I am following its existing similar principle. For example, just I am giving a brief idea. It may be happen in the future. So I am doing a different type of business. That type of business is not 100% covered as per that particular framework or standard. But I am following that. If I follow that, what are happening? My income statement is showing huge profit. So this analyst must concentrate, must aware of evaluating the financial reporting standard, whether those are suitable or similar to that particular business or not. If the new type of product or new type of innovation generation or generation of new type of revenue generation is happening, he must understand the consequences of that particular business if they follow these accounting standards. Like that, he cross-checking means based on the standards the companies are there. If the companies are working, these standards are perfectly applicable or not. Like that, he cross-check and give the proper analysis. You understand, I hope. And next, accounting, understanding income statements. Sir, please give me 5 minutes. I will be there in 5 minutes, please. Okay?
Okay, no issue.